right, welcome to the Multifamily Investor Nation webinar series. Today, we're going to be talking everything about the internal rate of return. This is not going to be a very long, extended webinar today. So this topic is a very misunderstood topic, and we're going to be talking about several different pieces to it. But the biggest thing is we're going to be going over the IRR in a little bit more detail, and so you have a better understanding of it. So it will probably be about maybe 15 minutes tops, and I'll also open it up for some questions and answers at the end. But it will definitely be a topic that you can, be referencing and referring to throughout. So let me go ahead and get started here by talking to you a little bit about myself. So I'm one of the managing partners of this group right here called PassiveInvesting.com. I'm Dan Handford, and you can find out more information about me and the rest of our team by clicking on the Meet the Team button. And my picture right here is at the top. You also have our two other managing partners, Danny and Brandon. And then, of course, you can see the rest of our team here at PassiveInvesting.com. We've got a phenomenal team. We're right now at about 31 full-time and full-time team members that work for our group. And each one of us there, you can find out more information. But if you click on my picture, you can click on that. When you click on it, there's a video here with a little more about me and my background. I am married, my wife there, Danae, and our 4 children. We have 3 girls and a boy. We live and work here in Columbia, South Carolina, so not too far away from what's going to be happening in June, which is up in Charlotte, which is the Multifamily Investor Nation Convention, which is MFIN Con, and it's going to be in Charlotte, 2022. It's an in-person, live, 3-day event in Charlotte, North Carolina, at the Charlotte Convention Center. You can find out more information about sponsorship opportunities, the speakers that we're going to be having, the location, which is going to be at the Charlotte Convention Center, and of course the pricing for this event. So make sure you lock in your tickets there. There are a limited number of tickets. We're planning right now between about 800 and 1,000 attendees for this event. So make sure you go there, find out more information, and lock in your tickets. You can go to mfincon.com to find out more information. It'll bring you straight to this page. And without further ado, let's dive into our topic for today. So today, we're going to be talking about the internal rate of return. So first off, let's kind of have a discussion around what is the IRR and how it is calculated. So the best way for me to describe this to you is to really answer the second question that is there on your screen, which is, what is the difference between IRR and ROI? So when you think of ROI and IRR, they seem somewhat similar, right? Because they're giving you the amount of return that you're going to have over a certain period, right? So let me just give you a quick example. So for those of you who are live with us here on the webinar, I want you to get your chat box ready, and I want you to give me an answer to a question that I'm getting ready to ask you. And what I'd like for you to do is share with me your response to this particular scenario. So if I have an investment where I put in $100,000, I put in $100,000 and I got $300,000 out, is that a good investment? So go ahead right now into the chat box. Let me know if you've invested $100,000 and got $300,000 out, is that a good investment? Yes, no, right? Which one is it? Everybody's saying yes, 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 absolutely, yes, yes, yes. Some people are saying depends, yes, yes, yes. What the time frame, how long? Well, depends. So the answer to the question is, it really depends. The reason why is because what I didn't tell you is that it took me 30 years to get there. So now, for those of you in the chat box, is that a good investment? You put $100,000 in, and you got $300,000 out, but it took you 30 years to get there, right? So you got a great ROI, return on your investment, right? But is that really that good of a return? How many of you would want to invest again in that same deal if you put in $100,000, got $300,000 out, but it took 30 years to do it? I mean, everybody on here is saying no, not great, not great. Exactly, and that is why the IRR is there and is in existence, because the ROI that return on investment does not give you any type of indication about how long it took you to get that money out, right? So the IRR bakes into the ROI the time component. So now you have a time component for how long it takes for you to get your money back over time and how fast that you were able to get that return of that money back to you. So IRR, when you first have a deal and you first put that 100,000 into a deal, the IRR is a negative number. You have a negative IRR because you have not recouped your initial investment. So your initial investment, your initial IRR is a negative number until you recoup all of your money back. And once you have recouped all of your money back, then it starts to become a positive IRR. But all that has to do with how fast money is returned back to investors. So the faster money is returned to you as an investor, the higher the IRR is going to be. But the longer a group holds on to your money, or the longer you as the group holds on to your investors' money, the lower the IRR is going to be. Now, IRR is typically always going to be lower than your IRR. The IRR is going to be lower than your IRR. Now, the IRR is always going to be typically lower than your annual return. This is just a straight annual return because it's taken into it the specific time value of money and when it's being returned over a period of time. Now, what I will say is that the calculation for IRR is definitely not a very easy calculation. So it's not one of those things you're just going to pull out your calculator unless you're a whiz bang on the calculator, but you're not going to really find a very easy calculation for this. And so let me share with you on my screen what this calculation looks like so you can kind of see why you're not going to do it. So as you can see here, it's talking about the net present value, talking about the cash flows over a period of time, and you're going to see how it all is calculated here, and it's based on how fast that cash flow comes in and it's being returned to the investors, right? And so obviously, I'm not going to go through this exact formula. I'm actually going to, if you want to find this article, you can actually just go to our website. Under this Knowledge Center, you can click on the word Knowledge Center and then just type in the word IRR, the abbreviation IRR, and there's this first article, Understanding the IRR. And for those of you who are joining us live, I'll type into the chat box so you can see this article that I wrote recently about the IRR and how it actually affects and what it has to do with monthly distribution, why our group does monthly distributions, which can increase your overall IRR over time. Also that IRR versus the ROI, and of course, why we never rely on just one metric. We don't ever just look at the IRR when we're looking at an investment, right? So you can find this article, look at it, and do some more research on it if you'd like to find that particular calculation. These calculations are primarily done via Excel, right? Or some form of software program that's actually going to do this calculation. Now, you can find IRR calculators online. If you just kind of Google IRR calculator, you can actually find calculators like, here's one right here I just pulled up. I just typed in IRR calculator and click the first link, and you basically are going to put in year 1 cash flows, year 2, year 3, year 4, year 5, and what your initial investment is up here, right? So let's just say we put in, we got 5,000 back this year, 8,000 back that year, only 1,000 in year 3, 3,000 in year 4, and they got a really nice payday in year 5. Or let's go ahead, if we didn't get our initial capital back and we're just talking about the investments here, it's actually going to calculate a negative ROI. And that's because in these years 1 through 5, you have not returned the initial capital. So if we wanted to say we're going to sell this thing in year 5, and we just make this 100,000, so it's 110,000 in year 5. Now we calculate it, and it's going to be a positive IRR. Okay. Hopefully, when we sell, we get a lot higher bump than that. So maybe we say this is maybe 140,000. Now we're at a 10%, right? Maybe we put this at 180,000 that year. Now we're getting 15% plus, right? And so the problem with this calculator, though, is it's not taking into account any type of monthly return of your investment, because IRR is not just on a yearly basis. It's actually on a daily basis on how fast your money is returned. So this calculator is only, of course, doing it based on a yearly cash flow perspective. But if you were to put it in here on a month-by-month basis, because we also, with our group, do monthly distributions with our investments, of course, you can't really use this calculator. It's not going to give you an exact amount here, okay? Now, using calculators like this or Excel are the best ways to be able to perform these calculations, because they are complicated and they are complex, as you can see here. I would not want to do this by hand. I will tell you that Danny on our team, he's our finance guru. He loves all these. He's kind of a geek when it comes to spreadsheets and numbers and finance and stuff like that. We love having him on our team because he's a great resource for us to be able to make sure that we're finding great investments and placing our capital in risk-adjusted properties. But he actually did this. He doesn't do it normally by hand, but he has done this by hand before, because he wanted to fully understand all the different nuances of all the different pieces to it. So he actually did this by hand to how to figure out these calculations. Me, I'm not that way. I don't want to do this by hand. It looks already too complicated for me as it is. I've done it many times on website calculators, as well as on Excel spreadsheets and things like that. But of course, it's good to have somebody like Danny on your team that loves those kind of numbers things and doesn't mind, pulling out a piece of paper and verifying some of these numbers when it comes to the internal rate of return. So let's go back to here. We talked about what is the IRR and how is it calculated. What is the difference between IRR and ROI? Now, how to increase the overall IRR? So if you're underwriting a deal, or you're underwriting multiple deals, and you're trying to figure out how to increase the IRR, the best way to do it is to try to figure out a way to front load or return more capital to investors up front instead of waiting down the road, right? Of course, it's benefiting the investors because they're getting that money back sooner rather than waiting, but it's also benefiting you because you're hitting those IRR numbers and those IRR targets, which is very, very good for you, because the faster you can return money to investors, the more they're going to want to invest with you. But if it takes you 6 months, a year, 2 years to return capital, but to give returns to investors, they're not going to probably want to invest with you until they start seeing some of those wins, right? They want to see those returns. They want to see those wins when you're trying to put together a deal, right? And so one of the best ways to increase the overall IRR is to return capital to investors faster. And I don't mean return capital. I'm talking about provide a return on the capital to investors. Now, doing a return of capital versus return on capital is not what we're discussing today. For those of you who have followed us for any length of period of time, I'm a big proponent of distributions being classified as return on capital, because it's a bigger and greater benefit for our passive investors. And those groups that do it as return of capital, it's really more benefiting them more than it is the investors. And I'm just not a big fan of that. So I'm not going to go into a big detailed discussion on that. But if you want to find out more information on that, you could probably go to our Knowledge Center on our website, type in return of capital or return on capital, and it'll give you an article there that talks about that. That's not the discussion for today. But one of the best ways to increase the overall IRR is going from quarterly distributions or biannual distributions to a more frequent distribution, like monthly distributions. So it's going to benefit you because your investors are going to see those returns sooner rather than later. So it does make it more challenging for you because you have a smaller number of deals to pull from, because it is hard to find deals that cash flow enough that you can actually return capital to investors over that period of time, right? Right away. I know a lot of deals that I've seen that are like really heavy value add deals. They do purport to have or project to have a higher IRR or a higher return, but it's because they are giving away, they're giving up short-term returns for the long-term appreciation, and so it has that higher bump at the end. But during the first year to 2 years, sometimes there's no cash flows being distributed to investors. And for me as an investor, I don't necessarily need cash flows, but I like the cash flows because I can take those cash flows and turn around and push it into another investment. And now I'm snowballing my investments faster than trying to hold on to that capital instead of having that investment group hold on to my capital for a longer period of time. So monthly distributions is a great way to try to help increase that IRR. but it does also affect which deals you can find, because it is hard. Our group actually just recently got a deal awarded to us yesterday out of Nashville, Tennessee. We've been looking inside of Nashville for quite some time now, and we finally got a deal awarded to us. We will hopefully be, in the next week to 10 days, releasing a deal out of that market. But one of the only ways you can make those deals work is making sure that you have great cash flows that are coming off that investment. So anyway, a little bit of a teaser on a deal that we're getting ready to release. Obviously, if you're interested in some of our future opportunities, you can go to our website, and under this current offerings tab, you'll see right now we have two current offerings. We have our self-storage fund, and we have our real estate debt fund. You can click on either one of those links to find out more information. You can also, if you just want to join our email list for some of our future offerings that we have available, you can click on this Join the Passive Investor Club button. And on that page, you'll see a form that you can fill out to be able to have a phone call with one of our investor relations team members to discuss your investment goals to see if our group is the right fit for you. So you can certainly do that, and we'd love to have you join us on some of our future opportunities. I don't know if you noticed in the Knowledge Center, but one of the asset classes that we just recently moved into is the express car wash investment asset class. And so you can find some more information about that particular opportunity that we have, the first deal that we released for car wash filled up within 2 hours. And we're closing that one on Thursday of this week. So it's not available for investment, but you can find out more information about that. The great thing about these passive express car wash investments is that there are a lot higher cash flows available with those investments. We actually offered a 10% preferred return on those investments from the very beginning, which pays out on a monthly basis, which is a great thing to be able to do and diversify your portfolio instead of just having everything weighted inside of the multifamily space. All right, so let's move on to this next thing here. How does the IRR compare to the AAR? So it is close, but the average annual return is all it's doing is taking into account. I put 100,000 in, and I got 5,000 back the first year, so I got a 5% average annual return. Average annual return. Now it's average annual return. That would actually just be the annual return if we're just looking at 1 year. When we look at the AAR, which is the average annual return, that is taken into account. Let's say we have a 5-year hold period. We're getting 5% 1 year, 10% the next year, and it's averaging out. It's averaging out all those returns over that period of time. Okay, and so we're going to take those and just divide it by the number of years. Now, when you're looking at IRR, it's a little bit different. We're not looking at it just on an annual basis. We're looking at it on a daily or monthly basis and figuring out, based on the time periods over time, how fast we're returning capital will allow us to have a higher IRR or a lower IRR, right? Now, your IRR is typically, like I said earlier, going to always be lower than your average annual return, because the average annual return does not take into account the daily or monthly time component. It only takes into account yearly, right? So that's the thing that you have to constantly look at and balance and that's one of the reasons why we look at the AAR is we want to have multiple metrics to be able to measure a deal. So we're looking at IRR, we're looking at average annual return, we're looking at cash on cash during the hold period, we're looking at overall cash on cash throughout the entire deal, which would be very similar to the AAR. We're also looking at the entry cap rates, the exit cap rates, and sensitivity analyses from those, and really kind of looking at a lot of different metrics all at the same time to figure out the quality, how much of a quality deal it may or may not be. Okay, we were talking to our team members at an event about a week or two ago, and one of the things that they mentioned is that they had looked at, they had this year alone, just since the beginning of the year, they've looked at over 150 deals. And of course, I kind of poked at him and made fun of him a little bit. And I was like, yeah, you looked at 150 deals and we don't even have a deal yet for 2022. Just busting their chops a little bit. But it's because we have very strict criteria that we're looking for, and we have submitted offers on several deals and just haven't gotten there. Somebody else overbid us or whatever. We have very strict criteria. This is our strike price. We can't go over that. This is it. And if we don't get to there, then we have to move on to the next deal. So even though we closed the deal last month, it was our largest deal to date out of Fort Myers, Florida. It was a $109 million acquisition, and we raised just over $38 million for that deal. That deal was released at the end of last year in Q4. I think it was end of November, maybe end of December when we released that deal, and we closed that deal in the beginning of February of this year, but we didn't release it this year. So we don't call that a deal that we found this year. So this year, our first deal is that one I mentioned earlier in Nashville, and we have a couple other ones that are kind of in the works in various different stages. And usually that's what happens in the first part of the year. Things kind of slow down due to the holidays, and it takes a little bit of time for them to ramp back up. So kind of January, February, March are a little bit slower. End of March, first part of April is usually when things pick up. Then it kind of snowballs from there. So we're looking forward to an exciting 2022. I don't see any questions coming in, so I think I've answered most of the questions that maybe you guys had with some of the content. If you guys have any further questions, feel free to type them in. Otherwise, we'll go ahead and wrap it up for today. The topic for next month, let me just refresh my screen and see if it's available. It's going to be from Danny Randazzo. So Danny Randazzo is going to be speaking next week. He's going to be speaking on the deal process from underwriting to closing for apartment syndication. You're going to learn about the 5-step deal process, qualifying the deal, running the numbers, touring the asset, full underwriting and deal process, PSA due diligence. So make sure you buckle up and you lock yourself in for that webinar. It's going to be a great webinar to be a part of. So thank you so much for being here. Looking forward to seeing you at the June MFIN Con. So if you have not registered for that, make sure you go to mfincon.com and find out more information and register for it. We'll look forward to seeing you there in person. Most of our stuff has been done virtually. So for those of you who have not met in person, would love to shake your hand, put a face to the name, and rub shoulders with you a little bit at that event in June in Charlotte at the Charlotte Convention Center. So let me give you the link here one more time into the chat box just so you have it. It's mfincon.com. And you can click on that and find out more information about the event and register. We'll see you back here next week for the next webinar in this series.